Well, business news now, and Stephen Carroll joins us on the set. Morning to you, Stephen.
Hi, Will.
You are beginning in the United States, where Donald Trump has again turned his attention to his country's economic relationship with China.
That's right. We were just hearing there about what he had to say about the American economy, but the president has also said that he wants to decouple the US economy from China. Now, that usually means a permanent drop in trade between two countries. Donald Trump made China a focus of his last presidential campaign in 2016 and is returning to the subject ahead of November's vote. He repeated a pledge from 4 years ago to block companies who outsource jobs to China from getting government contracts. Earlier this year, Washington signed a limited Phase 1 trade deal with Beijing after years of rising tensions between the world's two largest economies.
If Biden wins, China. So when you mention the word decouple, it's an interesting word. So we lose billions of dollars, and if we didn't do business with them, we wouldn't lose billions of dollars. It's called decoupling, so you'll start thinking about it.
The new figures show the French economy's recovery won't be as strong as previously thought. The National Statistics Office says the bounce back in the period from July to September will be less than forecast, with growth of 17%. That follows an almost 14% slump in the previous 3 months at the height of the pandemic lockdown. INSEE says the economic activity in the French economy is currently around 95% of pre-pandemic levels. It expects that to remain the same until the end of the year. Says the French economy will shrink by 9% this year.
On top of that, Stephen, France could be facing a shoe shortage. Will I be barefoot soon?
Potentially. Depends what state your shoes are in now, really, I think is the question. Manufacturers say they've been unable to keep up with demand and acquire the necessary materials to keep supplies in pace. That means that shops are facing up to a 25% drop in their supplies. Luke Shrego has the story.
School's no longer out, and with kids going back to class, new shoes are often on the shopping list. But for autumn 2020, there's far less on offer than usual, thanks to the coronavirus snarling up supply chains. This store is 25% down on stocks it should have, a major problem for shopkeepers at a typically busy time of year.
Ça représente facilement 40% de notre chiffre de l'année.
Last year, French consumers spent 8.7 billion euros on shoes, enough for around 300 million pairs, 4 or 5 per person on average at a budget of 130 euros. And with its own shoemakers faring poorly against foreign competition, particularly from Asia, 95 French manufacturers employing over 4,000 people are now struggling to get hold of the necessary raw materials.
On a eu des ralentissements, voire des ruptures complètes sur des approvisionnements, que ce soit de cuir, que ce soit de caoutchouc pour nos semelles, de lacets, voilà, tous les éléments qui vont constituer la chaussure.
This shoemaker's doing what it can to make up the shortfall for a target of 90,000 pairs for the year. However, they've had to make sacrifices, with a quarter of the autumn-winter collection not making it beyond the prototype stage.
Cette bottine, on n'a pas pu recevoir le cuir, donc on a pris la décision de ne pas lancer le produit.
One bright spot for consumers, prices were fixed long before the pandemic, so there won't yet be any unexpected price rises.
Turning next to Japan, where the economy took a bigger hit than previously expected between April and June due to the coronavirus pandemic. These are revised numbers that show the world's third largest economy slumping by 7.9% in that 3-month period. That's as consumer spending and exports plunged. Now, it's thought to be the worst slump the Japanese economy has seen since World War II. In percentage terms, though, the contraction is less severe than what's been seen in the United States or France over the same period.
And how is that playing out on the markets?
Well, it wasn't a surprise because it was a revision of previous GDP figures, so we're not seeing much impact today on what markets are trading. The Nikkei in Tokyo actually up slightly a short time ago, and a similar picture across the Asian markets. Not much movement, though. Of course, markets a little bit quieter after US share markets were closed on Monday for Labour Day. Let's take a look, though, at what's happening on the currency markets. We're keeping an eye on the pound sterling because of those Brexit negotiations getting back underway. The pound weaker against the dollar and the euro in trading today, of course, after those reports, the British government considering overriding parts of its withdrawal agreement with the EU. We tend to see Brexit drama play out in the currency markets as that's where traders see the impact. So we're expecting the pound to be weaker as those situation remains uncertain for the UK.
And staying in the UK, and reports of massive fraud in the country's furlough scheme.
The UK's tax authority says that billions of euros worth of payments may have been wrongly awarded in recent months. That's up to 10% of the 39 billion euros the British government has spent on the programme, which paid the wages of private sector employees who were unable to work during lockdown. HM Revenue and Customs says the wrongful payments range from mistakes to fraud. They're now investigating 27,000 cases where they believe employers claimed the wrong amounts of money.
Well, the move from working from home inspired by the pandemic is having an impact on demand for office space, isn't it?
That's right. Google has scrapped plans to rent massive new offices in Dublin. It was in talks to lease almost 19,000 square metres of offices in a new development in the city, but has changed its mind, according to Bloomberg. This, as the company told employees they can work from home until at least the middle of 2021. The tech giant employs over 8,000 workers at its European headquarters in the Irish capital.
But a very different point of view on the subject of working from home from the boss of Netflix.
Reed Hastings has been talking to the Wall Street Journal about this. He says that his workforce will be back in the office as soon as the majority of them can be vaccinated against COVID-19. The Netflix CEO saying that debating ideas is particularly difficult when people have been working from home during the pandemic. Hastings saying, "I don't see any positives. Not being able to get together in person, particularly internationally, is a pure negative." He says he's been super impressed at people's sacrifices during the period. Of course, Netflix, one of the big winners of the coronavirus pandemic, they saw a record jump in subscriptions with more people working from home, but Reed Hastings wants everyone back in the office as soon as possible.
That seems like an advantage to working from home, but
You can watch more Netflix.
all right. Thank you very much, Stephen. Stephen Carroll.